I'm Chris Wagner, Wealth Advisor at Vector Wealth Management. As we look ahead to 2026, it's an ideal time to review key strategies that can help position your finances for the year ahead. In this video, I'll share 6 practical financial planning tools to consider as you start the new year. Number 1, RMDs. Let's start with required minimum distributions, or RMDs. If you turn 73 in 2026, this is your first year of being required to take a distribution from your pre-tax retirement accounts, like an IRA or a 401k or simple plan. The IRS requires you to withdraw a percentage, pay tax on it, and then decide whether to spend, save, or reinvest the rest. From 2026 onward, you'll need to take RMDs annually. Timing matters, so consult your advisor. The deadline is December 31st or April 15th of the following year for your first RMD. Number 2, charitable giving. If you're over 70 and a half, you can make qualified charitable distributions directly from your IRA. This means you can send funds to a charity without paying tax on that amount. You won't see a tax deduction on your taxes, but you will avoid paying future taxes on those dollars since they go directly to a charity. Then once you are age 73 and required to take a distribution, the amount you give to charity will offset your RMD dollar for dollar. For example, if your RMD is $25,000, you could give $12,000 to charity and only pay tax on the remaining $13,000. It's a great way to reduce taxable income while supporting causes you care about. As a reminder, you can give up to $111,000 to charity via QCDs in 2026. Number 3, Roth conversions. Another strategy worth considering is Roth conversions. A Roth conversion refers to the process of moving money from a traditional IRA, individual retirement account, or other pre-tax retirement account like a 401k into a Roth IRA. Once converted, all qualified withdrawals from the Roth IRA are tax-free, including earnings. The catch, the amount converted is treated as taxable income in the year of conversion. As always, talk to your advisor about whether this makes sense for you. Number 4, beneficiaries. The new year is also a great time to review your beneficiary designations. Make sure your IRA, trust, and other accounts reflect your current wishes, whether that's family members or charitable organizations. When you name a beneficiary on those accounts, the assets pass directly to that person upon your death, bypassing probate entirely. In this way, account designations override the instructions in a will. Number 5, gifting and donor advised funds. In 2026, the annual gift tax exclusion remains at $19,000 per person. If gifting is part of your strategy, this is an excellent way to transfer wealth without filing a gift tax return. And if you're not yet 70 and a half and not eligible to make qualified charitable distributions, consider a donor advised fund, or DAF for short. This strategy lets you make a tax-deductible contribution now in the form of cash or securities to a DAF account and then distribute funds to charities over time. One powerful feature of this strategy is gifting appreciated securities, whether that's stocks, ETFs, or mutual funds, with large unrealized gains. By donating those assets to a DAF, you avoid capital gains tax and get an immediate tax deduction, and then move assets out of your estate for future charitable gifts. Number 6, 401ks and HSAs. For 2026, the standard 401k contribution limit for employees under 50 is $24,500. If you're 50 or older, you can add a catch-up contribution of $8,000. There's also a special catch-up for ages 60 to 63 that allow up to $11,250 extra if your plan permits. One big change starting January 1st of 2026 is high-earning participants 50 plus making more than $150,000 in the prior year at the same employer must direct all catch-up contributions in their 401k, 403b, or 457b plan towards Roth accounts. Employers should have prepared for this through 2025 and 2026 with plan design updates and system capabilities, as 2026 is a transitional year with formal compliance being enforced in 2027. If your employer does not offer a Roth component to the 401k, 457b, or 403b, then you are ineligible to make catch-up contributions. So check with your employer on that. Again, it starts in 2026. Lastly, don't overlook health savings accounts. In 2026, contribution limits are $4,400 for individuals and $8,750 for families, with an additional $1,000 catch-up for those over 55. The new year marks a perfect time to review your finances, goals, and get organized. Ready to take the next step? Connect with Vector Wealth Management today to schedule a conversation or introduce yourself. Have a great year, and thanks for watching.
All content discussed in our podcasts, videos, or related blog articles are for informational purposes and should not be construed as individualized financial advice. Opinions expressed herein are solely those of Vector Wealth Management, our staff, and guests. Material presented is believed to be from reliable sources. However, we make no representations as to its accuracy or completeness. All information and ideas should be discussed directly and in detail with your financial advisor prior to implementation of a strategy or investment.